coming in. I was going to ask you about the inverted yield curve, but actually, I was going to ask you whether what we heard over the weekend, especially from President Trump saying that Tim Cook of Apple had spoken to him, means that President Trump slightly going to change his tack, whether he's a lot more mindful about these market swings and the impact tariffs have on his companies.
Not only on his companies, but ultimately it's his base, the consumers, right? So the decision to push back implementation of tariffs, which could have hit Christmas shopping, he wants to make sure that's avoided. But now, if he's going to go one step further to make sure that supply chains don't get disruptive or there are no price increases, perhaps he is. He is sensitive to swings in the stock market and sentiment.
Okay, but what do you think the yield curve inversion means? Does it mean that are we just expecting more from the Fed, and otherwise the markets are going to be really disappointed?
I think we need to look at investor behavior. I do think it's investors, believing that we're in an environment where it's going to be lower for longer, especially in real rates. So they are just going further down the curve, to pick up some yield. Especially if you look at the pension funds and the insurers, with their longer-term liabilities, what can they do, right? So I think, that behavior has, driven market moves, and then, we, jump on the assertion, perhaps, that does it signal a recession coming through, and then it risks of becoming self-fulfilling. So let's look at investor behavior first, rather than worry about recession.
All right, well, speaking of investor behavior, Jeff, convexity hedging is being blamed for last week's plunge in bond yields. Explain what it is and explain whether this is comparable to what we saw in the lead up to the financial crisis in 2008.
So basically, this would be fixed income, traders, looking at, changes in the yield curve and, hedging their risks accordingly. Heading into 2008, if you just, if you recall, the process, we had a good point where it was called the Great Moderation, and the yield curve, was actually flat to inverted, and there were some, worries around that. But then households, through borrowing their mortgages, through spending on credit, that really started to take off, and then you saw a steepening in the yield curve again, and that took traders, that took the market, by surprise, and then we all know what happened next, right? So fixed income volatility in an environment where you can go from a very moderate yield curve to some degree of flatness and inversion to suddenly a steepening again. I think that's something we really need to watch out for, right now. Do we want to return to a taper tantrum period? Or even if we look at Europe, how about a bund tantrum?